The Japanese yen has been weak for quite a while. It's come down to 164 against the US dollar. That's the lowest in 40 years. And that was enough to trigger a remarkable intervention by the US. It stepped in to buy Japanese yen. But why is Washington coming to the rescue? And for those of us planning a trip to Japan, does this change anything? Hi, I'm Andrea Heng. Welcome back to the Money Talks podcast. And we are asking today, what happens when governments decide a currency has fallen far enough? And what happens if a currency rescue does not work? Questions that I am pitting to financial markets expert Simon Ree, founder of the Tao of Trading. He's also a former Goldman Sachs desk head with over 30 years of experience watching and trading on the front lines of the global markets. Welcome to the hot seat, Simon.
Thanks, Andrea.
All right. So why is a weak yen a problem for America that they have to get involved, and even the global economy? I mean, clearly a lot of us are watching this really closely because we have a lot of interest in going to Japan and spending money there.
Yeah, sure. Well, let's take a step back and ask why a weak yen is a problem for Japan first. And it's a problem because Japan imports nearly all of its energy and most of its food.
Got it.
So a weak yen creates a cost of living crisis, right? And one thing we've seen in Japan is we've seen 6 consecutive months of wage growth, and yet consumer spending dropped 3.3% in June. All right. So despite the wage growth, people are feeling poorer, and they're pulling in their spending because of the cost of living is rising.
Okay.
And then you've got the Iran war, the Strait of Hormuz crisis. That has added some immediacy to correcting this yen weakness. Now, in order to prop up the yen, the Ministry of Finance needs to buy yen,
Okay.
which probably means selling dollars. Now, the Bank of Japan owns $1.2 trillion worth approximately of US treasuries. So that is a source of US dollars for them that they could potentially liquidate, use that money to buy yen to prop up the yen. Now, the US Treasury doesn't really want Japan selling their US treasuries.
Okay, why not?
Well, that would be a bad headline. Right? Japan sells $100 billion worth of US treasuries. That would spook the treasury market. Now, we've got US 30-year yields at 19-year highs. US 10-year yields are at the highs for this cycle. If the market is worried that there's a new, potentially very large seller in the wings, that could spook treasury markets further, and we could see yields continue to ratchet higher.
Right.
And that reprices everything in the US economy, from mortgage rates today to data centers that haven't even been poured yet. So the US obviously doesn't want Japan selling US treasuries to prop up the yen. So 4 or 5 years ago, they enabled what's known as the FEMA repo facility that enables foreign central banks to pledge collateral with the New York Fed and then borrow against that collateral. And so that's what Japan has done.
Okay.
They've tapped that FEMA repo facility, and they are using those funds to buy yen.
Okay.
And the US also intervened, and we know that from a joint statement. They sold euros to buy yen. Now, the US isn't going to sell dollars to buy yen. That would be seen as unpatriotic, and that would be politically unpalatable. Selling euros is okay. We don't know what size they've done it in. There's that famous Reuters photograph of Scott Bessent's notebook to do buy $5 to $10 billion worth of yen. The fact that it's a joint mission, if you like, sends a stronger signal.
Okay.
Now, the timing, I think, also matters. As you said, the yen was touching sort of 164, which is, as you said, a 40-year low. You put that on top of an oil crisis, that sort of tells you why there was some immediacy. But in terms of why they acted 2 weeks ago, or a week and a half ago, we saw speculative positioning in the yen had reached an extreme. And that is a pretty good timing indicator for when the Ministry of Finance is going to act, because that's when buying a certain amount of yen buys you the biggest amount of movement. Because the people who've shorted the yen have to then cover, you get a bigger bang for your buck. So we saw the yen drop to 155 and change versus the dollar immediately after the intervention. So
Yes.
it's held, I think, slightly more than half of kind of the extreme low that it bought.
Let's get into the mechanics of what actually happens when the US and Scott Bessent and Co. gets involved and intervenes in the yen. So you talked about how they sold euro to prop up the yen. Give me a sense of how to visualize this.
Just to give you an analogy for perhaps why the US is doing this, imagine you own a semi-detached house, right? And your next door neighbour has lost his job. He can't pay the mortgage.
Yep.
His mother's fallen sick. He's got huge medical bills, and the house is worth $2 million.
Okay.
But he needs the money now, and he's going to put it on the market for $500,000.
Oh.
And you say to him, look, don't do that. Please don't do that, because if you do that, the value of my house is going to get destroyed as well. So you might step in there and actually lend him whatever money he needs to tide him over and get himself back on his feet, just so that the value of your house doesn't get dragged down by his fire sale.
And that's what the US is doing. The US is the owner of the semi-D house.
If you like.
That doesn't have a problem.
Yeah.
And the Japanese yen is the one with the sick mom, bills to pay, losing his job. So before the US intervened, the Bank of Japan did something, and they announced it after the fact, right, that they did intervene. Why didn't it work?
Well, the Bank of Japan has been setting the interest rate. All right, so they've hiked from minus 0.1% to 1% in the last 27 months. So basically one hike every 5.5 months approximately. But if you look at where core inflation is in Japan, the Bank of Japan's own forecasts have it at 2.5% to 3% by year end. So amongst major developed economies, the Bank of Japan has got the deepest negative real interest rates of any of them. So what you've got in Japan is a situation where the new Prime Minister is running very expansionary fiscal policy, loose fiscal policy. The Bank of Japan is running very cautious, aka loose monetary policy. So you kind of got weak currency almost as a policy byproduct. And so that creates a bit of circularity, right? You've got a weak yen, which causes rising inflation, which causes a weakening of the economy and weaker spending, which makes the Bank of Japan even more hesitant to hike, which causes weaker currency, and so it goes on.
Oh, so it's literally a vicious cycle almost that can't seem to end.
But that's the cycle that this intervention is hoping to break, or at least buy some time for.
Okay. But from what we see, from what we've seen historically, can central banks and central bank policy truly influence the FX market?
Yeah, I think it depends on how a central bank runs its policy. I mean, if you look at what the MAS does, for example, they effectively run their monetary policy through the exchange rate.
Correct.
So in the case of the Singapore dollar, I mean, the MAS has quite a good degree of influence. With the Bank of Japan, the degree of influence is smaller, which is why you have these sort of major one-off interventions.
Okay. I'm just wondering also now, if investors have strong reasons to sell yen, is intervention enough to reverse the trend?
Well, it depends on what the reasons are. I mean, obviously Japan would like domestic investors to perhaps repatriate some of their money and invest.
Which is what China
locally.
was doing, was trying to do for a while, right?
Yeah, and the idea has been floated in Japan. Nothing has been written into policy yet. But the fact remains, right now you've got a yield differential between US 10-year yields and Japanese 10-year yields of roughly 190 basis points. And whilst that yield differential is maintained, people are incentivized to short the yen, borrow in yen, invest elsewhere.
I mean, you've been watching and doing this for over 30 years. You've been on the front lines. What's it going to take to have the stronger yen last? Yeah,
so these interventions will provide a momentary reset.
Right, like a leg up almost?
Yeah, it'll sort of give the yen a boost. It'll shake out some speculators, shake out positioning. But so long as that yield differential is maintained, the position kind of slowly starts to rebuild again. So I think what it's going to take is for that yield differential to close. I don't know where it needs to close to. My best guess would be, somewhere south of 150 basis points.
Wow.
And as I said before, it's difficult for the Bank of Japan to hike aggressively because the economic situation there is somewhat fragile.
Yeah.
And let's face it, Japan's debt to GDP ratio is over 230%. So, it has an impact. Currently, I think more than 25% of the budget, Japan's budget, is already going to debt service.
Yeah, we remember that from when Prime Minister Sanae Takaichi took over the reins from her predecessor. So now the US has intervened. What kind of unintended consequences might arise from this intervention?
Well, I don't know that anything is going to happen just as a result of this intervention. But I think the more interesting thing to watch is going to be that yield differential between Japan and the US.
Okay.
Now, the market has currently got a US rate hike in September. If we get a rate hike, that's actually going to pull the yield differential in the wrong way for Japan and could lead to further yen weakness. Now, I think most of that yield differential compressing has to come from the US. Like I said, the Bank of Japan can't hike aggressively.
Yeah.
Most analysts have a terminal rate this cycle of 1.25. So that's one more 25 basis point hike. And that's expected to happen between now and the end of the year. So if you get further compression in that yield differential, it's going to come from US rate cuts, but we're not there yet.
Okay. So you talk a lot about yield differentials here in this past conversation. It brings to mind the yen carry trade. That's been a big theme between these two countries. What's going to happen to the carry trade now that the US has intervened? I mean, will the yen carry trade then slow down as a result?
Look, I think so. But there are kind of two legs to the carry trade. You've kind of got the levered version and the funded version.
Right.
So the levered version is people taking out yen loans because they can borrow cheaply and buying US treasuries and US AI stocks and US Mag 7 stocks and that type of thing. And then you've got the funded version, which is the Japanese pension fund, onshore Japanese investors seeking yield in other parts of the world and swapping their exposure back into yen. So the funded version is kind of the very, very, very slow moving. The levered version is the one that people worry about. Oh, what happens if we get an unwind of the carry trade?
Yeah.
And I think the yen carry trade unwinding, it's the big boogeyman in the closet that everybody knows about. And the big boogeyman in the closet that everyone knows about is really the one that really knocks you down.
Okay.
Now, if we get a couple of disinflationary rate cuts in the US, growth remains intact.
Yep.
I think everything's fine. So long as you've got US growth intact, asset prices rising, and let's face it, the stock market usually loves a rate cut, right?
Yeah.
You could see a very tidy unwind of that carry trade.
Okay.
If, however, we get a growth scare in the US and the Fed is forced into cutting and asset prices are falling and these are like emergency reactionary cuts, that's when an unwind of the carry trade could really kind of get messy and exacerbate things that are already kind of getting unglued.
Okay, so after the joint intervention, the yen is now hovering at 154 on my check to the US dollar. It's sort of given up half of its gains since the intervention. So observers say that the magic has faded. Do you agree with that? Would you call this rescue a failure?
No, I look, it's buying time.
Okay.
It's cleared out a lot of speculative positioning, and really, you look at the last couple of interventions, the playbook has looked exactly the same.
Okay.
You get a big flush, and then the positioning kind of slowly builds from there.
Okay. So for a Singaporean investor who perhaps may have a portfolio holding Japanese stocks or even an ETF with Japanese stocks in them, what does a stronger yen mean for their returns?
Well, I think the key thing to look at for a Singaporean investor is your Japanese exposure currency hedged or not?
Okay.
Right. So having currency hedged exposure has been the winning trade for the last 40 years, right? Well, certainly, the recent decades.
Yeah.
Now, if the yen is about to kind of change tack and go on more of a strengthening trend, those currency hedges are going to become a headwind.
Okay.
And it'll be unhedged Japanese exposure that gets the tailwind. So I don't know that there's anything you need to do today, but just know what you own and be aware of which way the trend is going.
Okay. You got to have the stomach for a little bit more volatility as it stabilizes as well. So this is going to be a question that I think a lot of Singaporeans have in mind. If I am going to be traveling to Japan over the next few months, has this intervention changed what I should do about exchanging money?
Well, it's probably made your holiday about 2.5% more expensive. And that's really it at the moment.
Okay.
It hasn't had a huge impact. Now, obviously, Sing Yen has strengthened a lot. If you go back to April last year, it was 107. Now it's sort of 120-ish. So Japanese travel is generationally cheap for Singaporeans.
Oh, for sure.
But if the yen is set to go on a more of a strengthening trend, then it's going to get a little more expensive.
Yeah, and that makes Japanese exports expensive as well. So even if you didn't travel to Japan, but you were buying Japanese products, appliances that you'd have to ship in, and I'm thinking about the businesses that are doing this as well, that's going to be an impact to the bottom line as well, right?
Yeah, exactly. If you're importing Japanese goods, they would get marginally more expensive, for sure.
So the last time that we talked about the yen was actually quite recently on Money Talks. We were told that it's quite safe to change your money to yen in bulk as opposed to changing in tranches. Do you think that wisdom still holds?
I'm not yet convinced that the yen is in an uptrend. Okay,
okay.
We've seen kind of a big shock to the yen, but as you noted, sort of the downtrend in the yen or the uptrend in the dollar versus the yen seems to be continuing. So I'm not sitting here thinking the yen is definitely in an uptrend from here.
Okay.
I think we would need to see that yield differential start to converge before I became more convinced of that.
So that window has to narrow a little bit before it is coming to a meaningful height.
Yeah, but before we could sit here and confidently say that the yen is on a path to continual appreciation.
Okay, so that's going to be a conversation for when that happens and if that happens.
I think I don't think we're there yet.
Okay.
Yeah.
That's a good note to end the conversation on. Thanks for joining us, Simon. This was really comprehensive, and I hope that this brings some clarity to people watching what's happening with this intervention as well. Thanks very much.
My pleasure, Andrea.
And to you, our Money Talks community, I have a question for you now. Are you planning a trip to Japan soon? And has all of this made you want to change your yen now or reconsider your holiday destination altogether? Because if, like Simon says, the yen uptrend is not quite there yet, you might still have some time for that one last big Japan holiday. I think so, at least. Tell me what you think. Leave your answers in the comment section wherever you're listening to us from. You can also email us directly, by the way, cnapodcasts@mediacorp.com.sg. This has been the Money Talks podcast. I'm Andrea Heng, signing off.